Hey investor friends, I'm Michelle Markey and today I'm going to recap the lessons I learned in how we should be investing according to super investor Guy Spier, who recently gave a talk with the Kolkata Investor Group in mid-November 2021. And as many of you know, Guy Spier is BFFs with Monish Pabrai, and both of them are disciples of investing greatest of all time, Warren Buffett and Charlie Munger. So if you also enjoy learning from some of the best investors, be sure to like and subscribe to my video and YouTube channel because there's so much wisdom from Guy Spier that I'm excited to share with you today, so thanks. As many of you know, Guy Spier runs Aquamarine Capital, which has about $350 million of assets under management with over 150 investors in it, and Guy Spier has about 25 years of investing experience, and some of the topics he covered during this 1 hour and 40-minute talk included how he is evolving his investing approach and also what he thinks about value investing compared to how the future of investing is increasingly going to focus on tech companies rather than old economy type companies, as well as his thoughts on valuation approaches and network effects and moats, and also his thoughts on macroeconomic factors like interest rates, inflation, and debt, and finally what he also thinks about cryptos. So there's so much that Guy Spier covered in this relatively short amount of time with this investor group. So it's really fascinating to see how a really great investor is evolving his investing approach and how we can take some lessons from that and try to apply it to our own investing practice. One of the ways that Guy Spier has been evolving in his investing approach is by putting more consideration into portfolio position sizing. And he said that his top 3 to 4 positions each comprise about 15 to 20% of his portfolio. So they make up pretty much 80% of his portfolio. And then he has a lot smaller positions. And he said that most of his top positions started out as somewhere below 5% of a position. So we can see that this is the case with Alibaba, where it's a significantly smaller position in his overall portfolio right now, and we know that he added Prosus to his portfolio in Q4 2021, and we can see across his top holdings, Berkshire Hathaway across the A and B shares make up $60 million worth or so, and then that's followed by American Express and Bank of America, as well as India Energy Exchange. And Guy Spier is really enthusiastic and excited about the future of investing in India, so he had a lot to say, even though he said he hasn't much experience in investing in India yet, but he has a lot of excitement about it. So I wouldn't be surprised if Guy Spier were actually invested in more companies throughout India that may not be reflected across either 13F or other kinds of reports. And of course, we'd want to know what Guy Spier thinks about the overall market conditions. And he said when it comes to deciding if the market is peaking, he can't say he knows where the market will go, but he said that much of his portfolio is not in tech and his overall exposure to tech is only 12%. And he said that he's staying fully invested and committed to equities, knowing it will be a bouncy ride. And he doesn't want to be like those people who are like the Chicken Little saying that the sky is falling and wanting to preserve a lot of cash, because those people will not be investing during uncertain times. So he made a decision to just stay fully committed to being invested. But my only follow-up question to that would be, where do you get the extra cash if you come upon a good buying opportunity? Does he have to make some hard decisions in selling some of his favorite positions in order to free up some cash to buy stocks that might be more on sale in the future? But I guess Guy Spier is totally okay with where his portfolio is right now, no matter what happens. And Guy Spier used the analogy of an oasis a lot when referring to the extraordinary, mind-blowing revolution in tech that's happening in front of our eyes. And he said with the advent of the iPhone and cloud and software eating the world, that started changing his investing approach, especially when Warren Buffett bought Apple in 2016. And even though Guy Spier understood the investing case for Apple 5-6 years ago, he didn't invest, and he seemed to sound a little bit regretful about it, but he's trying to be more open-minded about investing in tech. And he also said that it's better to look for water in the oasis of tech than to look for water in the desert of value, basically. So I thought that's very interesting to hear Guy Spier try to evolve toward trying to invest in tech more than how he'd been investing before. But he also said that there may well be a bubble if stocks are trading at 100 times earnings or revenues, like with Snowflake. And he said that if we don't look at valuations, that's kind of like bubble thinking and behavior. And he said that bubbles happen because a good idea is taken too far. And in using snow as an analogy, Guy Spier had known one type of investing approach, which is like one term of snow. But he said in the Eskimo language, there's like 30 terms for snow. So he's trying to understand the different variations of snow, just like there's different investing approaches. And he said that our greatest teachers can also be our greatest limiters. So I think he's kind of reconsidering what he used to know in terms of value investing with analyzing balance sheets and cash flow and income statements and trying to evolve that kind of thinking to look at other kinds of valuation metrics for what a lot of technology companies do or are based on, because a lot of these old-fashioned ways of analyzing companies may not be as applicable right now. And even though he said he was a dyed-in-the-wool value investor, and he says that people should just be patient and value investing might not be dead yet, but yet he's finding himself having to change. So clearly he's kind of trying to reconcile between which kind of approach is applicable in the times we are in now and whether value investing principles will still apply in the future or not, because he also said that this time is not different. He thinks that, actually when people say that this time is different, that it's really not. So you kind of have to just make your own decisions as to what is more truthful right now and in your own reality of what you're looking at and seeing the world in and how that sits with your investing approach. And I thoroughly enjoyed how Guy Spier was on a roll with all of his analogies, as I like using analogies too. And he used an analogy with an elephant to describe Bayesian probability in deciding whether a good business's moat was widening or not. And he said that we're like blindfolded people on different body parts of an elephant, where someone's touching the elephant's nose or tusk or tail, and we all have different exposures, and we're operating in a world with a lot of noise. So the best thing we can do is just try to be intelligent about our decision making, because he talked about how banks have been really dominant and have had high barriers to entry, but he thinks that their moats could be declining. And even if the moats are narrowing instead of widening, if a bank has a smart capital allocator manager, then they could still find a way to grow in spite of their moat declining. So this is just something to keep in mind as to how we think about the evolution of businesses. And he said that either way, people will gravitate to great business models. So all in all, maybe that's something to keep in mind as we're evaluating the extent of a business's moat and its durable competitive advantage. And on Guy Spier's thoughts about a company's culture and management and their operations, he pointed to things that we should look out for, such as asking, does this company have a noble mission where it has us becoming better off in society and where the company cares about all of its stakeholders and the company is trying to do well for all of its stakeholders and the community? And he said that some of these companies include the likes of Netflix and Coca-Cola and Costco and McDonald's, where they're trying to make communities better and to also have ecosystem control while having good relationships with suppliers and all kinds of stakeholders. And also when companies do this, like say Amazon Web Services keeping prices low, then customers will voluntarily lock into their business model compared to going to other competitors because they know they're getting good deals with some of these companies. And also Guy Spier cites Charlie Munger in saying, in order to be successful, the best way to do that is to deserve future success. And he also likens this to how if you're not doing something that's in the best interest of people and stakeholders, then your profits might get normalized. Eventually you might run into problems because you're not trying to do what's best for all the stakeholders. Because he also talked about examples with gambling and how Facebook might be the new tobacco, in that there are some stakeholders who are getting the short end of the stick. And even if they're highly profitable, they're eventually maybe going to run into issues that cause their profits to normalize. And that may not be the best thing for society in general if some of these companies continue to operate where some people get taken advantage of, and that's not the best business model. So those are basically Guy's thoughts in a nutshell of how we should think about how companies are behaving, and definitely look for if they have a noble mission. And he was asked if retail investors should invest in the top tech stocks and or with a certain fund manager. And Guy Spier responded that the way to invest in equities is to invest in them oneself, or to buy an index fund with a reputable provider, or to invest with a fund manager that treats their investors like their family and has the right orientation. Like Guy Spier thinks of his clients as almost like his own family. And he also is gathering a list of top venture capital funds funds, and he is also looking carefully at those VC funds as investee companies because they tend to attract the best resources and high quality engineers and marketing people. So he's also very interested in studying these top tech VC companies. And also he said that Prosus is among one of his positions because he said that their management explains their investment strategy in a very open and clear way that anyone can understand. And he also said that you don't have to necessarily invest in just typical tech stocks. Like Domino's Pizza has become highly differentiated in using tech, and you wouldn't normally think of Domino's as a tech company, but it just goes to show that a lot of maybe traditional kinds of businesses are integrating and adopting a lot of tech, that they're starting to become tech companies. So it just shows that we should carefully review all kinds of investment opportunities and see what's within our circle of competence. And one way is to gather a list of tech companies like Guy Spier is doing and start looking at those and see which ones we can understand. And Guy Spier related investing with networks and used a movie analogy, and he talked about a venture capitalist, James Currier from the firm NFX, who said that networks are valuable, but not all of them are. And some networks get more valuable as they grow, but others top out and reach a saturation point, like ride-sharing companies Uber and Lyft, where at some point no extra cars give benefits to clients, so they will eventually top out. And so you want to look at businesses that don't hit a saturation point. And he said that with eBay's network, Amazon did not succeed in toppling the power of eBay's network. So that just goes to show that networks can have really strong effects to be able to help a business continue growing. And he also said if you're associated with enough successful movies, you become a member of the Academy in the US, and then more opportunities flow to you. So what he said is you want to get to the center of that network where you become a better person by associating with better quality people. And that's why he said he went to the Ferrari analyst meeting in order to get closer to the center of the network where there's a lot of high quality people who are successful. So by getting closer to your network, that also improves your investing. And as to Guy Spier's macroeconomic thoughts on interest rates, inflation, and debt, he said that he thinks interest rates will remain extraordinarily accommodative. So I think that that means that there'll be dovish and kind of stay on the lower end instead of being too tight and then causing maybe a worse downturn in the economy and stock markets. And then in addition, he doesn't think inflation is out of control, and he thinks inflation is mostly localized. And he also learned about this concept of financial repression, where a government will force its financial institutions to accept its debt at the interest rate it requires. So he thinks that after World War II, we didn't see enormous inflation, and he probably thinks that we won't see that here again. And in addition, he said that central bankers and governments have ways of working off their enormous debt, and he said that he's not going to let that stop him from investing or having a fully invested portfolio. And then he kind of joked that he may have waffled for 5 minutes pretending to answer, but in the end he may have said absolutely nothing. So in general, I mean, macroeconomic factors can be a total crapshoot, so it's no fault of Guy Spier as to whether his thoughts on all of these things are correct or not. We're just gonna have to see what happens because the global economy is kind of a beast of its own, and we're just gonna have to see which macroeconomic factors end up playing out. Finally, on the exciting but controversial topic of cryptos and blockchain, Guy Spier doesn't think of it as rat poison squared like Warren Buffett called them before. And even though he cited Charlie Munger when saying that quote, he understands why Charlie Munger wouldn't want his grandkids to be playing with cryptos all day. But he says that he doesn't think people who dismiss cryptos outright are correct either. So Guy Spier is actually very open to learning more about crypto, and he's been part of learning groups to learn and understand cryptos better. And he said that he believes it's as revolutionary as when HTTP and TCP/IP came out as the plumbing of the internet. And he said that it's like having to know your ISP, which in this context is like kind of needing to know which is your bank that was giving you the ability to do financial transactions. But with the advent of cryptos and blockchain, he said it became trustless. So it doesn't really matter which bank in particular is doing it. Like it kind of becomes really neutral and agnostic as to which administrator is really helping the blockchain network to allow people to do financial services and transactions. transactions. And he also cautioned that even the ones that have the largest market caps like Bitcoin and Ethereum, he said the minute that something comes along that really does replace them better, he said that you can't be certain that any one of them doesn't go to zero. So that's a little bit of a precautionary tale to pay attention to perhaps, as well as how he thinks that when there's this kind of gold rush, you want to be the entity that's selling the pickaxes and jeans to all the gold diggers in this crypto gold rush kind of analogy. And he said that Coinbase is at the center of this, where he thinks that they're in a good position to be above board and trying to comply with all the regulators because they're acting as the cryptocurrency exchange. But at the same time, Coinbase has also been at the center of a lot of hacks. So that's something to be reconciled, where there's definitely probably some money and profits to be made, but it's really a tough call. And he said that he put cryptos in a too hard pile for now. And I have a few follow-up questions of my own, like if blockchain is set to become the future plumbing of the internet, then to what extent might it become a utility as offered by the likes of Verizon or other internet providers? Or will it become a financial service that gets brokered by a bank-like entity? Because ultimately, it might not be completely trustless. Like, I can't help but believe that someone will want to have the power of the blockchain and harness that to make their own profit. So I think that it won't just be a totally trustless system, but that there will be some mediators in between that want to get a cut of any and all blockchain transactions. And also, we know that banking has frictions with its transaction costs. So I'm wondering, how will blockchain overcome its frictions in its energy transaction costs while trying to make the environment more sustainable? Because I know that blockchain requires a lot of energy consumption, but that seems to be at odds with trying to make the environment more sustainable and have it actually exist for future generations. So how do you square that away? And I kind of wonder if whoever is trying to figure out this math problem might figure it out, that we can achieve positive goals of trying to make the internet a better and safer place and improve society while also maintaining the environment and have it be sustainable for all future generations. So the moral of this investing story with Guy Spier is that we want to invest in companies whose contributions to society are not zero sum, and that will have positive impacts for all of the shareholders and stakeholders involved. And if you enjoyed this video or learned something, please like and subscribe, and I wish you well on your journey to being the best investor you can be. Till next time.